U.S. oil exploration and production companies are unloved, shunned, and some are even hated. They underperformed the oil price in S&P last year. Why? Well, Wall Street poured more than $200 billion into the oil shale patch over the past few years, and most drillers can't even produce healthy returns. CEOs desperately want to change that. Here's how they can do it. Grow production on the cheap, which gets hard as current wells' rate of growth slows. Increase buybacks and dividends. Stay CapEx disciplined, don't increase production when oil prices go up, and be cash flow positive. Enter Parsley Energy. It just bought Jagged Peak for $1.8 billion, which helped it increase its presence in the Delaware Basin in the prolific Permian. The combined company now has 266,000 net acres, which allows it to drill longer laterals and will have more bargaining power with oil services providers to cut costs. There was $141 billion worth of M&A in the U.S. E&P space last year, and now it's up to them to prove to shareholders they were the right deals.
Well, Parsley recently reported earnings, and it sees free cash flow this year at $200 million at $50 oil. So I recently caught up with Matt Gallagher, the CEO, and talked about the company's oil production outlook.
You're starting to see a playbook evolve of what can actually be digested. It needs to be accretive on all cash flow and financial metrics. It needs to be in the same zip code, same neighborhood is even better, and it needs to enhance scale. If you do all those things and you can amplify your cash flow profile, it's being received relatively well. But the industry has had some step outs on the acquisitions front, on the M&A front that weren't received as well. So I think the playbook's evolving, and I think the last two deals have been received much better.
Where does the execution risk lie then? If you have to deliver such specifics for investors, where's the problem?
You can't overpromise. So that's the other part of these deals. So you have to have tangible synergies that you can deliver on, and you need quick wins, and then you need to deliver execution over the subsequent 4 quarters is usually the judgment time frame if these deals are working.
And what's the free cash flow leverage, the boost that you're going to get from this? Can you do it like a shorter term, longer term thing for me? Yeah,
so in the short term, we're going to be well north of $200 million a year of free cash flow on a standalone basis, and then this could accrete to that on the order of $30 million to $50 million just on the front year.
I feel like a year ago, the natural conversation would have been like, so like when's Chevron going to buy you? Like when Exxon's going to buy you? Is that still the conversation?
During 2019, they made some promises after the Oxy Anadarko deal. They said no high premium deals. So that has gone a little bit on the back burner from their narrative. But I would anticipate M&A to pick up in 2020.
Do you think it's going to be the majors, or do you think it's going to be tie-ups like you did with Jagged Peak?
I think there's a lot of work to be done on the smaller operators running 5 rigs or less. So I think that's where the majority of the operations will occur, or the mergers will occur. But I think no doubt that over the next 2-3 years, the majors need to make a move.
There is a discrepancy in the industry of how much shale can actually grow. I know you're going to be biased on it, but what do you think for 2020? I'm
actually probably biased in the way that you wouldn't expect. I think that shale is not going to meet its growth forecast. It's very difficult. When we look at the same counties, we call it same store sales, the well productivity is actually already declining. Other basins, the Bakken, South Texas, they're already on a productivity decline. I think the EIA, the IEA are forecasting productivity increases for the Permian. If you flip that, it's going to be very difficult to meet the forecast over the coming years. So we have to keep the focus on cost, and we have to imprint new technologies to extract more productivity out of these wells.
Why are we losing productivity? What's happening?
Well, you look at these reservoir systems, they're 2 miles under the ground, and it's essentially one large tank. So you have a pressure drawdown over years, and we use a 2 to 3% aging factor on our wells when we do our modeling. So it's just over a long period of time, as you extract resource, the pressure draws down, and it's harder to recover that resource in the long term. It
feels like the story now for 2020 is all the offshore stuff that's happening, whether in the Gulf of Mexico or more importantly Brazil or Guyana. It feels like the narrative's changing to that's where we're going to see more of their production growth. What do you think?
There's a big slug of production growth coming offshore worldwide, and it is Guyana, it's Norway, and these were projects sanctioned in the early part of the decade, 2010 to 2012. They're finally coming online. However, you rewind back to 2014 to 16, and that exploration capital just completely dried up. So again, you come into a time frame 21 to 2025, and we don't see a lot of these projects coming online. So there is going to be a big call on the U.S. shales to deliver, and we hope to do our part.